So John, you very kindly wrote the Q2 Rental Monitor survey for the commercial tenants. And just to give our audience some comfort as to what a tenant in good standing is, TPN records tenant payment behavior, which is tenants paid on time, paid late, partially, and not paid. And so a tenant that is in good standing is paid up by the end of the month. That includes any arrears balance that the tenant might have, the basic rent that was charged for the month, plus whatever their utilities are. The tenant that is paid up by the end of the month with a zero balance is a tenant in good standing. So what did Q2 tell us?
Well, it was an ugly picture, Michelle, but not unexpected. From 78% of tenants being in good standing in the first quarter, that dropped radically to just over 50%. To give you a bit of perspective, that's significantly lower than the percentage recorded just after the global financial crisis when the TPN data started. So it is a deep economic shock which caused this. We wait for the GDP figures in a few days' time, but that could tell us something like 30 or 40% GDP decline. And I think it's strongly reflected in the tenants' ability to pay. They were locked down. So in retail malls, a lot of them, not only in retail malls, in manufacturing, which is related to industrial property and logistics, in a lot of areas, a lot of tenants were just shut down and lost all their income, especially in April and May. And this is coming through strongly in a very serious drop in the percentage of tenants that were able to keep up with their payments.
John, you added some fascinating data into the rental monitor in terms of that loss in productivity from both the retail and the manufacturing sector. Share with us those numbers.
Yeah, so if you look at, we don't have high frequency economic data for office space. Let me firstly say that the worst hit was retail. Their percentage of tenants in good standing in 1 month in the second quarter dropped, in about April, dropped to 40%, and have only recovered slightly to around about 45%. So the majority did not keep up. Industrial looks a tad better than that, and office looks, I wouldn't say the best, but the least weak of the three major sectors. The retail sector and the industrial sector, which is strongly linked to manufacturing, probably received about the same economic knock. In about May, there was about a 50% year-on-year drop in manufacturing production and a 50% year-on-year drop in real retail sales. So the impact was fairly similar. We don't have high-frequency data from Stats SA for the office-related sectors. But I think the difference why retail has been hit harder, I think it reflects on the financial frailty, if you could call it that, of the retail tenant relative to an industrial property tenant. And that may have partly to do with retail property having run a lot harder for over the last decade or 2 decades or more, and having become a lot more inaffordable in terms of rentals, in terms of operating costs, in terms of values as well, than is the case in industrial property, which is the most affordable property class of the three. So it's probably on average easier for industrial tenants to keep up from that affordability point of view.
So if I can just quickly summarize then, only 1 in 2 tenants managed to keep their rental payments paid up and in full for the Q2. Retail tenants suffering the most at 45%, industrial tenants at around about 58% if I remember, and office tenants at 66% in good standing. What everyone wants to know is the recovery. And FNB speaks to a vacancy index from their brokers. What are we seeing in the vacancy index?
Well, firstly, let's just talk about the TPN data, which we've just done a preliminary split by month as well. It's preliminary data just to see early signs of any potential recovery, and the numbers are starting to look a little bit better in terms of those percentage of tenants in good standing as we move into July. So there is some immediate relief just because the lockdowns have been eased and people can start trading again. They might not be back to 100% sales, but 50% or 70% or 80% is better than nothing. So it's improved the environment noticeably after the April and May hard lockdowns. I don't think that. I think what we will see for the foreseeable future is a portion of the tenant population, unfortunately, a portion of them still closing their doors. A lot of these impacts from a shock like the second quarter will play themselves out over the next year or 2 years, and you will see more not being able to make it because sales have not returned to full levels of, say 2019, and so they close their doors after trying to survive for a certain amount of time. That's the unfortunate reality, because this economy probably won't get back to full speed for a year or two. Our vacancy trends, we survey a sample of property brokers on the 3 major commercial segments, and all of them, office space, industrial, and most notably retail space. There's a strong bias from the brokers in terms of when we ask them the question, have vacancy rates risen, fallen, or stayed the same over the past 6 months? Strong response. The overwhelming majority in all 3 sectors say risen. And I think that's the reality. Commercial vacancy rates already were rising gradually for a few years. But I think that this shock of the second quarter probably accelerates that. Now, to give you an idea of how long it might take before you turn the corner and vacancy rates start to come down, back in the 2008-9 financial crisis recession, the big contraction in the economy was, or the biggest, was in 2009. Vacancy rates bottomed out in 2007, and as the economy started to slow in 2008 and into recession in 2009, you saw rising vacancy rates. The economy late 2009 started to recover already. GDP growth started to accelerate. 2010 and 11, we still saw a rise in vacancy rates. So I think that gives some people perspective. We're probably going to be in a rising vacancy rates trend for the next year or two. And we need this economy to get back to full recovery, in other words, GDP at a level of 2019 plus, before I think we can hope to start seeing vacancy rates then turn downwards once again. And I think that might be a few years away.
So John, what we're expecting then is a very long and slow and gradual recovery. This isn't going to be an overnight recovery for the market.
No, and the reason is that already in the second quarter, a portion of the production capacity of the economy has closed down, and more should follow if it's a normal deep recession. So you open your doors again, you start doing business, but a certain portion of the businesses that contribute to the overall production of an economy are not there anymore. So production capacity has been trimmed. So it takes time before new businesses, new companies, new factories, or new step in to fill that void and then crank up the production to where it was pre-COVID. So that's a time-consuming process. It doesn't, some of us just assume lockdown's finished, business as usual. Well, for those that still exist, but unfortunately the hard knock has shut a portion of the capabilities of this economy down.
John, thank you very much for joining us. That's TPN's commercial rental monitor for Q2. Thank you.
It's a pleasure.